for joining us and for watching this video. Don't forget to subscribe and like this video if you're in grade 12 and doing accounting. On today's video, we'll be focusing on ratio analysis, and I won't be covering all the ratios, hence this video is called part 1. Part 2 will cover the rest of the video, the ratios that are not covered in this video, as well as the example from an exam paper. I'll be mainly focusing on the profitability ratios as well as the liquidity ratios in this video. What is the purpose of ratio analysis? Ratio analysis is a useful management tool that will improve your understanding of financial results and trends over time and provide key indicators of organizational performance. Ratio analysis is used to pinpoint the strengths and the weaknesses of the financial position and performance of the entity. It is also used to compare the company's financial performance to similar firms in the industry to understand the company's position and the market. You can also use it to see if there's any trend in the financial performance of the company. You can use it to determine the financial degree of efficiency in the management of assets and liabilities. So basically what all of these things mean is we have our financial statements, which would be your cash flow, your income statement, as well as your balance sheet. And we all see numbers, but what do those numbers mean? We are interpreting the numbers. So we have 1 million profit, but our revenue was 10 million. What does that mean? So we just interpreting the numbers that we see on the balance sheet. We're interpreting the numbers that we see on your income statement as well. Are we making money? It's one thing to see numbers, but are we really making money? Are we really profitable as compared to other entities of the similar industries, or as compared to last year and the previous year? What is the trend here? Where can we improve? Are we doing well? This is what ratio analysis is about. As I've already mentioned, we're going to be covering the profitability ratios as well as the liquidity ratios. The profitability ratios, they used to measure the business ability to earn profit relative to their associated expense. Are we profitable? Are we making more than we incur? Are we making money? So this is what profitability ratio is about. If we are recording higher profitability ratios than the previous years, it means that we're improving, we're doing well. Maybe we've cut on our expenses or our cost of sales. Also, you can use it to compare to similar firms similar firms to see, are we really doing well as compared to our competitors? The first ratio that we'll be covering is gross profit on sale. This is gross profit over sales multiplied by 100. You need to remember that gross profit is sales minus cost of sales. You get your gross profit. Gross profit on cost of sale. How much are we making as compared to the cost of sales? We have net profit on sales, which is your net profit over sales multiplied by 100. Your net profit is your gross profit minus the operating expenses. The last one that we'll be covering is operating profit on sales, which is operating profit over sales multiplied by 100. This is an example of profitability ratio. So we have our income statement here, and the first one that we're going to cover is gross profit on sale. As we already discussed, gross profit over sales multiplied by 100 is how we get our gross profit on sales. If you go to your income statement, you see that the gross profit was 6,000 over sales of 10,000 multiplied by 100. We get 60%. It means that we're making 60% out of our sales. So after we have subtracted our cost of sales, the cost to make the sale, we are left with 60%. Again, Seeing 60% on its own does not mean anything. You need to compare it to your to the results of your previous years, as well as maybe similar entities in your industry, to see, is it a norm? Are we doing good? Is it okay? Gross profit on cost of sales is gross profit over your cost of sales multiplied by 100. If we go again here, gross profit is 6,000. Our cost of sale 4,000, and we're making 150%. Net profit on sale is net profit over sale. Our net profit here is 3.5 over sales of 10,000. It means that we're making 35%. So net profit, remember, it is sales minus all of your expenditure, all of it, including tax, your operating expenditure, your cost of sales, and then we get your net profit. So we're making 35%. What does 35% mean? You need to then compare it to your last year to see any trends. Are we improving? Are we in the same? Are we the same as last year, or the past 2 years? Also, you can compare it to your competitors as well to really get an idea of how you're doing. The operating profit is operating profit over sales multiplied by 100. Again, we go here, operating profit is 4,000 over 10,000 multiplied by 100, then we get 40%. So those were the profitability ratios, and I hope you understand them. We're going to be covering liquidity ratios just now. Liquidity ratios measure a company's ability to meet its debt obligation when they become due. Usually they become due in a year or 12 months. So when a company is experiencing financial difficulty and is unable to pay its debt, it can convert its asset into cash and use the money to settle any pending debts with more ease. So before we get into which ratios are those, I want to explain. So we have our non-current liabilities as well as our current liabilities. The non-current liabilities, they are due in 5 years, in 2 years, but not in the next year. The current liabilities are those creditors that are due in the next year. And we usually use the current assets to cover the current liabilities. Our current asset would then include our inventory, which is current, our debtors, as well as the bank, the money that is in the bank, because we can just get it tomorrow. So anything that we can get in the next 12 months, those are our current assets. The current ratio then is the current assets over current liabilities. Can we use the money in the bank account, inventory, as well as the debtors to cover the current liabilities, which can be our creditors? So this is what the ratio is about. And we have the acid test ratio as well, or the quick ratio, which is your current assets minus inventory over current liabilities. How quick can we cover our current liabilities? So we can only rely on the debtors as well as the cash in bank to cover our current liabilities. So this is an example. We have a balance sheet. The first one that we're going to cover is a current ratio, current assets over current liabilities. If you look here, our current asset is 17,000, and the current liabilities get 2,000, and we get 8.5. So this means that we have our assets are 8.5 times more than our current liabilities, and we are in a great position to be able to cover our current liabilities when they become due. So usually it depends on the norm. The norm can be 2.1, 2 is to 1 or 1 is to 1. When it is 1 is to 1, it means that our current assets are equal to current liabilities, which can be good. It means that we'll be able to cover those current liabilities when they become due. But in this example, which is not really a norm to have 8.5, it means that our current assets are 8.5 more than the current liabilities, and we'll be able to pay them when they become due. Again, you need to compare it to the entities of similar industry or the previous year's financial results or ratios to see if we're improving, if we're doing well. Quick ratio or acid test ratio is how quick can we pay our current liabilities without having to use inventory? Because inventory is not quick if you think about it. The debtors, they can pay us tomorrow, as well as the cash that is in the bank is quick because it's the cash that is in the bank. How quick can we do that to cover our current liabilities? So here I would just say our current liabilities 17,000 minus the 2,000 minus 5,000 inventory, and we left with 12,000 divided by the current liabilities of 2,000, and we get a 6. It means that our current assets without the inventory can still be able to cover the current liability 6 times. So that's all I've prepared for you guys today. Thank you again for watching. Stay tuned for the next video for more ratios. We'll be covering solvency ratios and other ratios that were not covered in this video, as well as an example from an exam paper. Until then, goodbye.